the story of India shopping the globe for oil after the imposition of a 50% tariff, especially in the lead-up to a high-stakes Trump-Putin summit, cannot be understood without first appreciating the broader geopolitical and economic context. India, as the world's third-largest importer of crude oil, is highly dependent on global energy markets to fuel its economy, power its industries, and sustain the daily lives of its citizens. A sudden and significant tariff hike of 50% on oil imports from a particular source or across certain geopolitical lines forces India into a complex balancing act. It must not only secure affordable energy supplies to meet its domestic demand, but also ensure that its foreign policy priorities and international relationships are not jeopardized in the process. This backdrop becomes even more sensitive when placed against the timing of a Trump-Putin summit, where US-Russia relations are in the global spotlight. Any moves India makes in sourcing oil will be closely scrutinized by both Washington and Moscow. Given that energy is not just an economic commodity, but a tool of geopolitical leverage, the United States, under Donald Trump, was actively using sanctions and tariffs as instruments to reshape global trade flows and geopolitical alliances. Russia, on the other hand, views its energy exports as a critical means of maintaining influence and securing partnerships. In such an environment, India's oil-buying decisions are more than a matter of economics. They are a statement about its strategic priorities. India's diversification of oil suppliers in response to the tariff is not an isolated move. It reflects a long-standing strategic policy of reducing overdependence on any single nation or region for critical resources. By shopping the globe for alternative sources, whether in the Middle East, Africa, or Latin America, India sends a message of resilience and adaptability. This approach also helps to mitigate price volatility, since over-reliance on a limited set of suppliers can leave an economy vulnerable to sudden political or economic shocks. At the same time, India must navigate a delicate diplomatic path. A stronger oil trade relationship with certain countries could invite disapproval or even retaliatory measures from others. For example, boosting purchases from Russia at a time when the U.S. is seeking to isolate Moscow could strain New Delhi's ties with Washington. Conversely, leaning too heavily towards U.S.-aligned suppliers could cool relations with Russia, a long-standing defense and strategic partner. The stakes are therefore unusually high, as oil trade intersects with security cooperation, defense procurement, and India's broader foreign policy doctrine of strategic autonomy. In essence, the 50% tariff shock is more than an economic inconvenience. It is a test of India's diplomatic agility and economic foresight. The decisions made in these weeks could ripple through not just the energy market, but the very fabric of India's geopolitical positioning. As the Trump-Putin summit approaches, every barrel of oil India buys will carry both economic weight and political symbolism, making this a moment where energy policy is inseparable from grand strategy. India's search for oil in the wake of a 50% tariff increase is fundamentally about energy security, ensuring that the country's fuel supply remains steady, affordable, and immune to political shocks. Energy security is not a short-term concern, but a long-term national priority, as the nation's economic growth is directly tied to its ability to meet rising energy demands. With a growing population, rapid urbanization, and expanding industrial output, India's energy needs are surging. Any disruption in oil supply, whether due to geopolitical tensions, tariffs, or global market instability, can slow economic momentum, raise inflation, and hurt livelihoods. The imposition of a steep tariff forces India to adapt quickly. It must secure oil from new suppliers, negotiate favorable terms, and ensure that the costs are not passed on excessively to consumers and industries. This is where economic strategy becomes vital. New Delhi must leverage its diplomatic relationships to secure long-term contracts, diversify the sources of crude, and even explore creative payment arrangements such as local currency deals or barter agreements to reduce dependency on U.S. dollar transactions, which are more exposed to sanctions and currency volatility. Shopping the globe for oil is not merely a reaction, it is a strategic investment in resilience. By building a network of suppliers across the Middle East, Africa, Latin America, and even deepening ties with Russia despite the tariff challenges, India can insulate itself from over-reliance on any single geopolitical bloc. This diversification reduces the risk of supply being cut off during times of conflict or diplomatic fallout. It also strengthens India's bargaining power. When multiple sellers are competing for India's business, New Delhi can negotiate better prices and terms. However, energy security is not just about buying oil, it's also about reducing vulnerability to oil itself. This situation could accelerate India's push towards alternative energy sources such as solar, wind, and biofuels, as well as increasing its refining capacity to handle a wider variety of crude grades. The government may also prioritize expanding strategic petroleum reserves, which act as a buffer during supply shocks. Economically, the 50% tariff presents both challenges and opportunities. On the one hand, the immediate cost of importing oil rises, potentially fueling inflation and hurting industries reliant on fuel such as transport and manufacturing. On the other hand, this crisis can stimulate investment in domestic exploration, refining, and renewable energy sectors. In the long term, a more self-reliant energy strategy will make India less vulnerable to external shocks. In the lead-up to the Trump-Putin summit, India's oil-buying decisions will be read as a signal of its economic priorities and strategic alignments. Will it lean towards us-friendly oil exporters to maintain goodwill in Washington? Or will it deepen its relationship with Russia, using energy as a foundation for a multipolar foreign policy? India's challenge is to secure affordable energy without compromising its broader strategic autonomy, a delicate act that requires both economic pragmatism and geopolitical finesse. India's hunt for oil after the 50% tariff does not exist in a political vacuum. It plays out in the delicate arena of international diplomacy, where New Delhi must navigate competing pressures from Washington and Moscow. This balancing act is one of the defining features of Indian foreign policy in the 21st century. On one side, the United States is a critical partner in technology, defense, and trade, as well as a key player in India's Indo-Pacific strategy to counterbalance China. On the other, Russia has been a time-tested ally, supplying defense equipment, nuclear technology, and energy resources for decades. The Trump-Putin summit adds an extra layer of complexity. In the days and weeks leading up to such a meeting, the global geopolitical stage becomes tense with speculation and maneuvering. For India, this means every purchasing decision, every diplomatic statement, and every bilateral meeting is carefully scrutinized by both Washington and Moscow for signs of alignment or deviation. If India were to overly favor one side, it risks alienating the other, potentially compromising strategic interests. Washington's stance on global oil trade is often intertwined with sanctions policy, particularly on countries like Iran, Venezuela, and at times Russia itself. When the U.S. imposes sanctions, it expects its partners, including India, to comply. But India's energy needs sometimes require bending these expectations. For example, Russian oil often comes with competitive pricing and favorable credit terms, making it economically attractive despite Western disapproval. Choosing Russian oil in defiance of U.S. sanctions can irritate Washington. But cutting ties with Moscow's energy exports could weaken India's long-standing strategic partnership with Russia. At the same time, Moscow sees India as a key customer and a bridge to broader engagement with the global South. Energy sales are not just commercial transactions, they are political tools that deepen interdependence. For Russia, retaining India as a major buyer sends a signal that it still has strong partners outside the Western Bloc, even amid sanctions and diplomatic isolation from the West. For India, continuing this relationship ensures access to reliable supplies, advanced defense systems, and strategic goodwill in a multipolar world. The balancing act is further complicated by the optics. If India appears to align with Russia during the lead-up to a US-Russia summit, it risks being perceived in Washington as undermining US strategic objectives. Conversely, if India swings too far towards US-approved suppliers, Moscow might interpret this as a betrayal of trust. This is why New Delhi often frames its oil buying decisions in purely economic terms, highlighting market prices, supply stability, and commercial needs rather than ideological alignment. In many ways, India's energy diplomacy is a microcosm of its broader foreign policy philosophy: strategic autonomy. Rather than being pulled into a binary choice between East and West, India seeks to maintain diversified relationships that maximize its leverage. The 50% tariff only heightens the stakes, forcing New Delhi to demonstrate that it can make independent decisions in its national interest, while still engaging constructively with both Washington and Moscow. India's global hunt for oil in the wake of the 50% tariff is not just a story about diplomacy. It's an economic drama with consequences that extend far beyond the borders of the subcontinent. At the domestic level, the price India pays for oil directly impacts everything from transportation costs to the price of basic goods, since India imports more than 80% of its crude oil. Even minor fluctuations in international prices can have a significant effect on inflation. When tariffs push prices upward, industries that depend heavily on fuel like logistics, aviation, manufacturing, and agriculture see costs rise almost immediately. This cost escalation trickles down to consumers in the form of higher prices for food, goods, and services. Public transportation fares may rise, airlines may increase ticket prices, and freight charges could go up, creating a cycle where higher energy costs feed into overall inflation. The political implications of such inflation are never far from the minds of Indian policymakers, especially in a country where fuel prices are a sensitive electoral issue. Governments often face pressure to cut domestic taxes on fuel or provide subsidies. But these measures constrain public finances, forcing trade-offs in other areas like infrastructure investment or social welfare programs. On the global stage, India's decision to diversify its oil suppliers, especially in large quantities, can have a noticeable influence on market dynamics. When a buyer of India's scale enters new markets, it can drive up demand and nudge prices higher, particularly in regions with limited spare production capacity. For example, if India turns to African, Latin American, or Southeast Asian suppliers in search of more affordable crude, the sudden shift in buying patterns can cause a surge in spot prices in those regions. This doesn't just affect India, it can impact energy importing nations around the world. There's also the currency factor. Oil is typically traded in US dollars, and a spike in oil import bills can increase India's demand for dollars. This can put pressure on the Indian rupee, making imports more expensive across the board and potentially leading to a widening trade deficit. A weaker rupee can, in turn, make it costlier for Indian companies to service foreign debt, adding another layer of financial strain. Internationally, India's oil purchases can influence broader geopolitical energy flows. For example, by buying more oil from non-traditional suppliers, India can create new trade corridors and long-term contracts that reshape global shipping and refining patterns. This could weaken the market dominance of traditional Middle Eastern suppliers over time, creating a more competitive landscape that benefits large buyers but pressures producers. Finally, the ripple effects are not purely economic, they also influence investor sentiment. Global investors watch India's energy policy closely, since rising oil prices can slow economic growth, dampen consumer spending, and raise the risk of inflationary shocks. Any perception that the 50% tariff and the subsequent oil buying spree might destabilize the economy could lead to cautious investment behavior. India's frantic search for oil following the 50% tariff, isn't just about plugging an immediate supply gap, part of a bigger long-term shift in how New Delhi approaches energy security. Policymakers are recognizing that relying too heavily on a small set of suppliers leaves the country vulnerable to sudden price shocks. Geopolitical disputes and sanctions. The latest developments have essentially accelerated India's push toward diversifying both the sources and types of energy it depends on. Historically, a significant portion of India's crude oil came from the Middle East, especially nations like Saudi Arabia, Iraq, and the UAE. While these countries have been reliable suppliers, global events such as production cuts by OPEC+, regional instability, and shifting alliances have shown that depending on a narrow supplier base can be risky. By shopping for oil from Africa, Latin America, Russia, and even exploring deals with smaller producers in Central Asia, India is signaling to the world that it intends to create a more balanced import portfolio. This approach not only provides flexibility, but also strengthens India's bargaining power. As suppliers are aware that India has multiple alternatives, beyond geographic diversification, India is also reevaluating the types of energy it invests in. The short-term oil hunt is being paired with an acceleration of renewable energy development, such as large-scale solar projects in Rajasthan, wind farms along the southern coast, and hydroelectric expansion in the Northeast. While these clean energy initiatives can replace crude oil in the immediate future, especially for transportation and industrial use, they form a crucial part of India's 20-30-year strategy to reduce dependence on volatile global oil markets. Another key element of this diversification is investment in strategic petroleum reserves, SPRs. India has been steadily building underground storage facilities capable of holding millions of barrels of crude oil. These reserves act as a buffer during global supply disruptions, allowing the country to weather short-term crises without panicking in the market. The current tariff situation has renewed calls for expanding SPR capacity and ensuring it is filled when prices are favorable. India is also exploring more long-term forward-looking strategies like securing upstream oil and gas assets abroad. This involves Indian companies such as ONGC Videsh purchasing stakes in oil fields in countries like Mozambique, Brazil, and Russia. By owning a share of production at the source, India can shield itself from some of the volatility of open market buying. The diplomatic side of this shift is equally important. Diversifying energy partners requires careful foreign policy balancing, especially when some suppliers may be geopolitical rivals or under Western sanctions. India must manage relationships so that deals with one nation don't alienate another, all while keeping an eye on its own national interest. Ultimately, the 50% tariff has served as a wake-up call, pushing India to accelerate moves it was already considering. Energy diversification is no longer just a desirable glitz, now a strategic necessity. The long-term policy shifts emerging from this crisis could define India's energy landscape for decades to come, potentially making it more resilient, self-reliant, and diplomatically agile in the turbulent world of global energy politics. The impending Trump-Putin summit turns India's oil calculus into a live geopolitical chessboard, where every move signals intent and shapes leverage. Summits of this kind rarely produce only what's in their real impact is in the unwritten understandings they create and the market expectations they trigger. For India, the central question is whether Russia, bargaining tightens or loosens the financial and logistical constraints around Russian energy and, by extension, how much room New Delhi retains to pursue a price-first energy strategy without incurring punitive costs. First, consider the sanctions architecture. A summit that results in a harder U.S. line through stricter enforcement, expanded secondary sanctions, or tightened shipping and insurance restrictions would raise the compliance premium on any barrel with Russian fingerprints. That premium doesn't only affect Russian origin crude, it bleeds into freight rates, insurance risk, and working capital needs for traders and refiners. In such a scenario, India's two hedges become vital. One, demonstrated ability to pivot volumes toward the Middle East, Africa, and the Americas. And two, the diplomatic capital to argue that Indian purchases are market stabilizing, not sanction busting. Conversely, if the summit creates carve-outs, tacit de-escalation, or longer grace periods, India can keep its diversified basket intact while using Russian discounts to anchor domestic inflation expectations. Second, the optics of alignment. Washington will read India's procurement patterns as a signal of strategic intent. Moscow will do the same. India's task is to frame every oil decision as a commercial choice aimed at macroeconomic stability, ever as a geopolitical endorsement. Expect New Delhi to reinforce this narrative with parallel moves. High-visibility energy deals with U.S. and Gulf suppliers, participation in IEA consultations, and quiet back channels with Moscow to secure predictable flows at market-reflective terms. This dual-track approach protects India's long-standing equities with Russia, while telegraphing to the U.S. that India remains a reliable partner in the Indo-Pacific, the Quad, and critical tech corridors issues Washington values more than squeezing every marginal barrel. Third, the OPEC Plus variable. The summit's ripple effects won't occur in a vacuum. OPEC Plus production discipline or strategic loosening can amplify or mute any sanctions shock. If tighter U.S. enforcement coincides with OPEC Plus supply restraint, Brent could surge, compressing India's fiscal space and complicating monetary policy. India's response toolkit then must include accelerated drawdowns, replenishments of strategic petroleum reserves timed to price dips, temporary excise calibrations to smooth retail prices, and synchronized tenders among state refiners to extract better terms. If, instead, OPEC Plus signals flexibility and Russian barrels remain movable via alternative routes, India's diversified sourcing strategy can keep landed costs manageable. Fourth, transactional bargaining chips. Summits often unlock side deals, humanitarian exemptions, shipping insurance workarounds, or specific corridor arrangements, for example, transshipment points or designated logistics hubs. India should prepare ask lists that are not RISA-specific but supply stability-oriented, like predictable maritime insurance coverage, clarity on due diligence thresholds, and standardized documentation that reduces legal ambiguity for traders. These plumbing wins don't make headlines, but they meaningfully reduce friction and cost. Fifth, managing the China factor. A prolonged squeeze on Russian exports to India could deepen Russia's dependency on China as a buyer of last resort, strengthening a Beijing-Moscow price corridor that is strategically suboptimal for New Delhi. Maintaining a credible Indian offtake channel, however modest, helps prevent a two-pole oil axis that sidelines India in Eurasian energy flows. Here, India's participation in BRICS, the SCO, and the International North-South Transport Corridor becomes more than diplomacy. It's leverage to keep options open across finance, logistics, and long-term upstream access. Sixth, market signaling and macro stability. The RBI watches oil like a hawk because every $10 swing alters inflation trajectories and current account math. Ahead of the summit, India benefits from pre-committing to transparent procurement auctions, timely release of import data, and coordinated communications between the finance and petroleum ministries. Clear signaling dampens speculative volatility in currency and bond markets. Simultaneously, forward purchases and optionality-rich contracts, 50/5 term spot mixes with destination. Flexibility can cap upside risk without locking India into unfavorable floors. Finally, strategic narrative. India's public line should stay consistent. Diversified sourcing is a macro stability imperative. Energy choices are apolitical, rules-compliant, and pro-market. And India contributes to global price stability by spreading demand across regions. Privately, New Delhi will keep three doors open, deepening Gulf partnerships for volume, reliability, maintaining a functional channel to Russian molecules for cost, discipline, and scaling. U.S. LNG crude ties to anchor the relationship with Washington in tangible energy security benefits. In short, the summit is not a binary risk, it's a probability tree. India's best outcome is flexibility preserved, discounts accessible, and compliance costs predictable. The way to get there is meticulous hedging, commercial, diplomatic, and narrative so that whichever way the big power bargain breaks, India's energy security remains intact. Economically, higher oil prices feed directly into India's inflation rate. Fuel costs affect transportation, manufacturing, and even food prices. Politically, rising fuel costs can become a flashpoint for public dissatisfaction, especially in an election year. Energy security isn't just about having enough oil today, it's about ensuring reliable, affordable supplies for decades to come. The current crisis has exposed just how vulnerable India's energy strategy is to geopolitical shocks. It underscores the need for greater investment in renewable energy, domestic oil exploration, and long-term supply contracts that can withstand political turbulence. His moment is also part of a larger story, the shifting power dynamics in global oil politics. As traditional alliances are tested, new energy corridors are emerging. Countries like China are rapidly locking in long-term deals, while the U.S. is leveraging its shale oil boom as a geopolitical tool. For India, the lesson is clear. Energy dependence translates into strategic vulnerability. The current crisis may be painful, but it could also be the catalyst for a more resilient and diversified energy future. After the Trump-Putin summit, we could see several scenarios. The best case for India is a de-escalation of U.S.-Russia tensions leading to tariff adjustments that make Russian oil affordable again. The worst case is further sanctions and trade barriers, which would push India deeper into expensive and politically complex supply arrangements. In either case, India's ability to adapt quickly, negotiate shrewdly, and maintain strategic autonomy will determine its success.